Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at Monegenics.com. Monegenics.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet, unqualified, to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. Why don't you recommend universal life insurance very often? I've never seen you recommend it on your email list. This question again. Okay, so several reasons. First, the risk profile. Second, the purpose of the policy. And thirdly, the carriers selling these UL policies. So I feel like I've told this story before, but I don't know. I feel like I'm maybe a broken record at this point. Back in 2005, I got into this business back in 2004, and I started at the Metropolitan Life Insurance Company, MetLife, which ironically does not sell life insurance anymore, which I think is really funny. So I don't know. Maybe I'm the only one who thinks that's funny. But the MetLife Metropolitan Life Insurance Company no longer sells life insurance, not individual policies anyway. So anyway, I started there, and basically my first job there, my boss handed me this. He walked me over to this filing cabinet. We had filing cabinet. We had an office, had a back room, like cubicle type stuff. There was a long desk that sat on that faced one of the windows in the back, basically faced an alley, I think. And then the room was just filled with filing cabinets and rows and rows and rows of filing cabinets. So he walked me over to his filing cabinet. He pulls open one of the drawers, big metal filing cabinets. Pulls open the drawer, pulls out a folder, and there was just stacks and stacks and stacks. And just he's like, "Here, go through these." And they were just lists of names. I said, "What are this? And what's this?" And he said, "These are orphaned policyholders, basically policyholders of the company that no longer had an agent assigned to them." And the agent had left the company, retired, he died, something, right? Something happened to the agent. Anyway, these people had not talked to an agent in 5 years, 10 years, maybe longer. And here I'm new, right? And so he said, "Here, you call these people, tell them you want to review their policy. You've been assigned to their case," and blah, blah, blah. So I called them, and I made phone calls to people, and when you look at you had all the details and stuff. You're like, "Oh crap!" They like, this policy is going to lapse in this year. So you call people, and try not to scare them, right? Mr. Jones, this is David Lewis from MetLife. I'm just calling to review your policy. I have some important information about your life insurance policy. So most people would call back. "What's this all about?" Blah blah blah. I said, I don't know how to tell you this. I have like bad news and good news. What do you want first? Of course, everybody wants the bad news, right? And I would say, like, I don't want you to be mad at me. I'm new here, so don't, I'm just the messenger. But you've got this life insurance policy. It's a universal life insurance policy, and our records show that this thing needs either more premium or something's going to happen. This thing's is going to crash. It's going to lapse. There's some ways that you could save it, different without having to raise your premiums and whatnot. I'd like to come over and talk to you about it. Most people would be very willing to set an appointment, have me come over and talk to them. So I spent almost all of my time. I spent some trying to get new business, but I spent a lot of time reviewing existing universal life insurance policies. There was hundreds and hundreds and hundreds of these cases, and they were all basically in the same boat. I mean, a lot of these UL policies were sold in the 90s and some in the late 80s or whatnot. But I was talking to people who had bought a policy at some point in the last decade, and here I am, and I'm telling them, hey, there's a problem, and of course they're mad. They weren't mad at me. I mean, they were just upset about how come nobody told me this, and it's like, well, you do get annual statements every year. But there were no agents assigned to them, so nobody was reviewing these policies with them. And in almost every case, what had happened was the agent had sold a policy to somebody, and they had pitched it like this. There used to be an old saying. It was called pay 3 and then you're free, or pay 4 and then no more, or something like that, right? Meaning you could pay 4 annual premiums or 3 annual premiums, and the interest rate on the UL policy was so high that all you had to do was pay 3, and it would illustrate the thing would just go on forever, and the cash values would just sing, and that was it. That was all you had to do. They don't do that anymore, but a lot of the policies were like this. So it was, well, you got to keep paying premiums on this thing to keep it in force, or we have to reduce the death benefit. And if that doesn't work, and we'd run different scenarios. I say, if either one of these don't work, then let's just replace it. I can get you a policy that this will never happen. You'll have to pay premiums, but this will never happen again. On a guaranteed basis, a whole life insurance, it'll never happen. Guaranteed universal life also will never happen as long as you pay the premium. And no more, funny illustrations or anything like that. I'll just set you up in a simple policy with no gimmicks. And people would take me up on that offer just because, I don't know if I was probably just a terrible salesman, but it was basically I don't have any cool sales presentation. I'm just telling you this is what I can do for you, And that was my job, was to review it. And I learned a lot about the universal life business just doing that, the product, how they're built, what they do and what they don't do. The big benefit to a UL is the flexible premium. The fact that 1 month you can pay $1,000 and then the next month you can pay $0, and the insurance company doesn't care how much money you give them. All the money that you pay in what's called a planned premium. There's no guaranteed level premium in a UL. There's no guaranteed premium. Nothing's guaranteed. There's a guaranteed minimum interest rate, but that's a gross interest rate before expenses have been deducted. There's a guaranteed maximum expense charge, but that's usually the insurance company's not charging the guaranteed expense charge. They're usually charging a much, much lower current assumption, or assumed charges. So there's planned or assumed charges and planned premiums, and then there's a planned crediting rate, or a declared crediting rate. But there's no there's in terms of net guarantees, there's no net guarantee on death benefit or cash value. That just doesn't exist. The insurance company is not going to promise you a net death benefit. In other words, they'll guarantee gross values before expenses because they can pull levers and change all that stuff. There's no guarantee on net cash value or net death benefit. It's all an assumption-driven product. So you can pay premiums. You pay premium, it just goes right into the cash value, and then the company deducts the cost of insurance every month. And if you put $1,000 in, they'll just keep deducting the cost of insurance until the cash value is gone, and then your policy lapses. You'll get a bill, a notice. Hey, you owe us some more. You got to give us some more money, or this thing's going to lapse. You put in another $1,000 and just wait for it to go, until the funds drain down. In that sense, UL is basically like a permanent term product, a permanent term insurance policy. And that's how I started thinking about it. And that's really what it is. It's a 1-year annual renewable term mated to a cash account. And you just keep dumping money in the cash account, and then they just keep deducting the money out of there to pay for it. Now, you can overfund the cash account and just keep putting cash in there, and they'll keep deducting the cost of insurance. And if you put enough cash, if you pay enough premium into the cash account, you can maybe overwhelm, the cost of insurance, and the deductions will keep coming out, but maybe the interest plus your premiums will just make the cash value grow really big. But but there's no guarantee that that will happen. And you're just sort of, in a sense, just kind of trying to stuff as much money as you can into this cash account and hope that there's more money going in than is coming out. And in fact, the old sales, the way that they used to sell Universal Life is they draw a picture of a bucket with a hole in the bottom. It's like a leak, like a leaky bucket with like water coming out. Like, hey, you put your premiums in there, and then there's some stuff that just leaks out the bottom, and you just have to keep filling it faster than the leak, right? So if you can fill this thing up faster than with premium and then interest on your premium dollars, for the insurance company's going to give you interest credits. So you got to you put a hose in there and hopefully you fill it up faster than the leak than the bottom, then maybe you can keep your policy. They actually use that as a sales pitch. I don't know. To me, it's kind of insane. But that's a benefit. You have flexible premiums, and it's your premiums go in, expenses come out of the cash account, and then whatever's left over gets credited back with whatever the declared interest rate is. The way the interest gets credited in those depends entirely on the type of UL it is, but that's the gist of it. That's in that sense is pretty simple. The actual crediting mechanisms, it'll either be a declared rate, in other words, be based on fixed interest, whatever the current interest rate is, what they call new money rates or current interest rates, or a variable rate that's dependent on what's sub accounts, which are essentially mutual funds. They don't call them mutual funds, but it's basically what they are. Or the newer product, which has been around for I think now 20 years or so, is the indexed crediting strategies, where they basically they're buying calls like a bull call. It's basically a bull call spread on typically on the S&P 500. So they'll use it'll be a bull call spread where they're selling a call and then buying a call. And they'll do that at different strike prices on the S&P, and they'll use the same expiration date. If anybody, I don't know if anybody in the audience is familiar with how options contracts work, but they'll sell a call and then buy a call at the same, they'll buy a call and maybe like an at the money, and then they'll sell a call like higher up on, it's like a higher up on a strike, and it's the same expiration. If it's a 1 year, they'll buy 1 year out, and then the difference, they'll go, 10% up or 12% up or 5%, whatever, that becomes the cap rate. And then you go, and then they'll just they'll just track the price action of the S&P, and when the call option increases, or when the price action goes up, the value of the call option goes up. It'll go up to whatever they sold. If they sold a short call at 10% up, the most you could make is 10%. The insurance company's not actually making any money off that. Because they're hedging that. They don't really care what happens to the index. They're not making money there. They're making money off the bonds, the interest on the bonds. They're making money off the policy charges. That's where they're going to want to make their money. They're not going to make money off speculating on the S&P price movement. They leave that to the policyholder. The policyholder takes the risk on that one. But that's the way they do the crediting on that. So my main issue with the product is it's more risky than whole life insurance, and risky in a way that doesn't make sense to me. I'm not saying it's bad, nobody should buy it or anything. To me, it doesn't make a lot of sense. It has a structural disadvantage over other products like whole life insurance. I could see a legitimate argument for saying it has a higher crediting potential, maybe higher performance potential. I understand that, and I understand how they would do that and why it would be that way. And there's a legitimate case to be made that has potentially a higher crediting potential. But in practice, what I have personally seen in practice is that a whole life policy, the ULs, it's much easier, first of all, to lapse a UL policy than it is a whole life policy, just due to the fact that there's no guaranteed level premium. Everything on the expense side is assumption driven, and if the assumptions don't pan out, then they reserve the right to, if they don't work out in the insurance company's favor, they're going to figure out a way to raise the policy charges and lower the crediting rate to make it work for them. They're not going to sit on an unprofitable book. They're either going to sell it off, and then the new company who buys the book is going to do that, or the issuing company is going to do it. So somebody's going to do it. They're not going to sit there with an unprofitable product. And this could kick off secondary consequences like requiring a higher premium to keep the policy in force or something else. So with whole life insurance, the expenses are guaranteed and fixed. And it's on a glide path. So they calculate in advance how much they're going to charge you at age 60, how much they're going to charge you at age 50, how much they're going to charge you at age 40. They have that all worked out in advance, right? It's not like the expenses just stay like $2 and then they never increase. They know the cost is going to increase, and they bake that right into the product. They have that already planned out. They figure out what the premium has to be, what the interest rate has to be to make it so that the cash value grows guaranteed every year. The death benefit stays level guaranteed every year, and so on. They just figure that out, and then they say, here, this is a premium. We can earn 3%, 4%, whatever it is. And here's what the premium has to be at that interest rate forever until age 100 and 120 or whatever. We can guarantee this thing out for as long as you live. And that's it. And then that's what they charge you. So, and the expenses are guaranteed and appropriately matched to the premium and the guaranteed interest factor. So there's no assumptions about what's going to happen. The insurance company is legally and contractually compelled to pay you the guaranteed interest factor on net cash values on the whole life product. So even on the non-guaranteed side of the contract, the insurer is also compelled to pay you dividends, on a participating whole life product, if there is sufficient net income and surplus to pay them. They can't opt out arbitrarily of paying dividends if there's money available to pay them. So when a mutual carrier doesn't pay dividends, it means there's no surplus. There's no divisible surplus or excess funds to pay them, which is, that's basically the insurance company is going to go into receivership, or they're going to be bought out by somebody. That'd be a dire situation. With a universal life policy, interest credits are at the discretion of the insurance company. It's a declared interest rate at the discretion of the insurer. So they're not obligated to pay you any specific amount of money except the amount that's specified in the contract. But other than that, nothing. And the contracts typically specify a guaranteed minimum crediting rate that's lower than the total allowable maximum expense charges. So those are built specifically with the idea that if the insurance company had to, they could flip the switch and make it so the thing just dies. And that's for the benefit of the insurance company, not for the policyholder. So on some of the newer, like the indexed UL policies, they do specify guaranteed. They'll specify things like guaranteed bonus credit of some kind. It's usually not enough to make up for the additional maximum mortality charges, though. In all cases, I would say the universal life product is designed to be a non-guaranteed product. The guarantees are not the benchmark like they are in whole life insurance. So with whole life insurance, a premium is always due. You can pay for it in different ways, but it's always due. You can let the policy pay for itself if there's enough accumulated dividends and paid up additions in the policy. You could pay out of pocket. You could do what's called a reduced paid up option, but one way or another, some way that policy has to be, the premiums have to be satisfied. Either way, the premium is going to be due, right? But for UL, there's never a guaranteed premium. You just put the premium in whatever you want, right? So policy charges come out and that's it. What I'm trying to get across, I sound like I'm repeating myself. It's because what I'm trying to get across here is that while both universal life and whole life share some common ground, the purpose and function of each policy type is very, very different. So in plain English, the premise of whole life insurance is to plan for the worst, hope for the best, right? The premise of universal life is to plan for the optimal scenario and then hope for the best. It's like plan for the best, hope for the best, and that's it. With whole life, it's completely opposite. Plan for the worst and then hope for the best. And in my mind, that's really kind of cuts to the heart of insurance and how it's supposed to function, how you're supposed to think about it. Whole life insurance is an evergreen product. It works well in any economic environment. Universal life, by contrast, is really a trend product. And it's always been that way. It's tweaked to very specific economic environments and trends. So, for example, current assumption UL was made for the high interest rates of the 1980s. Variable universal life was made for the 90s when, stock market was really booming and stuff. It's made for a time for bull markets. That's what it's made for. That's how they price them and how they configure the product. Index life was made for more of a choppy market, like in the 2000s, and that's what it was made for. Is that carriers had like large cash piles? They were sitting on large piles of cash they could use to buy the options, the calls, the spread, the credit spreads. And then they were like, yeah, we could take advantage of that and just credit the interest based on options profits. Which works really, really well. A bull call spread works well in a choppy market, but when the market is rising, they don't work that well. That's why options traders don't use them. They use them as hedges. They don't use them as like, hey, I'm going to make a whole bunch of money on this thing when the market goes up, because you cap yourself out. And if the market goes down, you don't really make any money. And if it chops sideways and it's like moderate growth, you can make some money, but otherwise you don't. Like, it's hard because it's a debit spread, so you have to pay. You're not earning a credit on the thing. You're paying a debit, and then you have to overcome the cost of the options to hopefully make a profit on that. And those are very specific market conditions that have to exist in order for you to do that. And they're not like, it's not a perennial, like this is going to happen all the time for the next 20 years. It's just not, that doesn't work. It doesn't work that way. So thirdly, so basically universal life is the middle ground between investing and a guaranteed insurance policy. So my heretical viewpoint is if you want to invest. This is not investment advice, by the way, but if it were me, I'm like, if you want to invest, right? If you want a guaranteed asset, buy whole life insurance and skip the middle ground. Just don't do it. That's not going to do anything very well. So, and thirdly, the companies that sell dividend paying whole life insurance form the bedrock of the life insurance industry and arguably the financial services industry as a whole. They don't just have financial ratings that are stellar for their industry. Their ratings are stellar for any industry. So stock companies, on the other hand, which tend to sell mostly universal life as their core product, they're a mixed bag. Some operate very clean businesses. Others feel like they're constantly playing some kind of a shell game, replacing old products with new ones. They basically, which is kind of the old story of what happened with Ameris when Aviva bought them out, and then Aviva sold out to Accordia. And so they're like you basically shuttle the old product, introduce a new product, rebrand it, subsidize your new product with the old policyholders, and then next year you're like, I want to introduce like version 2 of this product. So you shuttle that old product that you sold last year or 2 years ago, or whatever, 3 years ago, or whatever. And then you introduce a new product, subsidize the new product with the old policyholders who are now, nobody cares about them anymore. And you just keep doing the cycle, right? So I've seen that firsthand. That's not a guess, by the way. I've actually seen companies do that. Lower the cap rates on older products to subsidize newer products. And I couldn't believe the first time I saw that. I couldn't believe it. The reason I know that they do that is because I've witnessed it firsthand as a general agent. I've seen it. I've seen them do it. And it was like, what the hell are you guys doing? And it was just like, no, we think this is great for business. And I'm like, whose business? There's an old saying in financial services. It's like, well, the firm made money, the agent made money, and well, 2 out of 3 ain't bad. My choice is to stick to a handful of well-run, old-school mutual life insurance companies that sell strong, accumulation-focused whole life. And, if somebody wants to buy term insurance, I love term insurance. There's some great term insurance products out there that do wonderful things. They're not a replacement for whole life insurance. And so I think each one has its place. But if you want permanent insurance, my personal opinion is go for whole life insurance. And if you want to do risk on, there's a universe of options out there in equities and real estate and everything else for risk on assets. And for insurance, that's where you put your safe money. That's my opinion about it. And that's the way, historically, that's the way that it's worked really well. Is life insurance is the conservative asset that protects your money, and equities is where you go when you want to make money. And anyway, that's my viewpoint on that. Anyway, thank you for the question. This is a wonderful question. I know every once in a while I keep getting questions like this, and I think I've revisited this a couple of times. But hopefully this kind of puts the, I don't know, nail in the coffin or something of this. Thanks again for the question, and I will see you in the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, MONEGENIX.com, and sign up for my daily email list.